Finance. Module 1. Grasping Bookkeeping and Accounting Basics. Introduction to the module. This module provides an overview of bookkeeping and accounting, distinguishes their differences, outlines the objectives and cycle of accounting. Lastly, fundamental accounting equation is briefly discussed. Topics to be covered. Simple knowledge of bookkeeping and accounting. Identifying the differences between bookkeeping and accounting. Objectives of accounting. Accounting cycle. Fundamental accounting equation. Summary. Simple knowledge of bookkeeping and accounting. In a nutshell, accountants keep the books of a business, or a nonprofit or government entity, by recording all financial activities and preparing summaries using systematic methods. Financial statements are created using this summary information. Stakeholders get financial statements. Stakeholders are persons who have an interest in the success or failure of a company. Here are some stakeholder examples. Stockholders. If you own shares in GE, for example, you will get financial reports on a regular basis. Stockholders are the company's proprietors. They must be aware of the financial state of the company they own. Creditors. Creditors are people or companies who lend money to your company. They'll look at your financial accounts to see if you're still able to pay back the loan's principal and interest. Regulators. Almost every firm is subject to some form of regulation. You must submit financial reports to the Food and Drug Administration if you make food, FDA. One of a regulator's responsibilities is to review financial statements. The parts that follow will assist you in beginning your path to a better grasp of bookkeeping and accounting. You'll learn about the contrasts between the two and get a bird's eye view of how they interact in this section. Identifying the differences between bookkeeping and accounting. It's crucial to distinguish between bookkeeping and accounting since the two aren't fully interchangeable. Bookkeeping is primarily concerned with the record-keeping parts of accounting, the process, some would say drudgery, of documenting all of the particular information pertaining to a business's transactions and other operations, or other organization, venture, or project. Accounting includes the design of a bookkeeping system, the establishment of controls to ensure that the system is functioning properly, and the analysis and verification of the recorded data. Accountants issue orders, while bookkeepers carry them out. Bookkeepers devote more time to the record-keeping process and the challenges that develop as a result of recording so much data. Accountants, on the other hand, are focused on a distinct set of issues. Accounting may be thought of as what happens before and after bookkeeping. Accountants build the bookkeeping and accounting system, before, and use the data entered by bookkeepers to compile financial statements, after. Objectives of accounting. Accounting's goals in any organization are to systematically record transactions, categorize and analyze them, generate financial statements, assess the financial status, and assist in decision-making using financial facts and information. Transaction identification and recording. Accounting's main goal is to detect financial transactions and record them in a methodical manner in the books of accounts. As a result, the genuine nature of each and every transaction may be determined without much effort on the part of the user. With this goal in mind, transactions are first documented in a general and a particular journal, and then numerous accounts are permanently maintained in the ledger. Determination of the final results. Every business wants to know how its operations performed at the end of a specific period. To establish the amount of profit or loss for a certain time period of a business concern, an income statement can be generated utilizing ledger account balances of revenue sort. The revenue surplus or deficit of a non-trading corporation for a particular period can also be established by generating an income and expenditure account or statement. Determination of financial affairs. Another important aim of accounting is to determine debts, liabilities, property, and assets, i.e. an organization's entire financial affairs at a certain date. A balance sheet may be used to identify a company's financial situation at a certain point in time. A balance sheet is a financial statement that shows a company's assets and liabilities as of a certain date. Maintaining financial records. The cash book is an essential component of the accounting records. All monetary receipts and payments are recorded in this book. This book records daily cash receipts, payments, cash on hand, and cash in the bank. By keeping a scientific and precise cash book, fraud, forgery, and money misappropriation are reduced. Management of assets and liabilities. In order to run a lucrative business, a businessman needs acquire a variety of assets such as land, buildings, machinery, and so on. He will have to deal with several duties and liabilities, such as accounts payable, notes payable, loan, bank overdraft, and so on, in addition to the acquisition of assets. Keeping correct records can reveal the genuine situation of these debts, liabilities, property, and assets. A businessman can take the required steps to keep the ratio of assets to liabilities under control. Cost-cutting and money laundering prevention. The main purposes of accounting are to avoid money defalcation through fraud and forgeries and to maintain track of the company's expenditures. Preventing money defalcation and managing expenditures becomes easier when accounts are managed scientifically. Availability of economic data. Another noble purpose of accounting is to transmit all economic information, such as financial statements and reports, to all parties involved in a timely way. Providing assistance with tax reform. Accounts prepared in accordance with recognized accounting standards are considered trustworthy by income tax and VAT authorities for assessing and paying tax and VAT. Policy development and evaluation. Accounting's purpose is to help management create and review management policies in order to successfully administer a business by supplying pertinent data, interpreting, and analyzing financial statements. The accuracy of the accounts is checked 10 times. One of the main purposes of scientific accounting methods is to guarantee that appropriate records are preserved. A trial balance can be performed to confirm that the accounts in the ledger are arithmetically correct. A trial balances agreement is proof of account arithmetical accuracy. The advantage of taking out loans is that borrowing money from strangers is regarded required to do business due to a shortage of funds. Without first understanding about a company's financial status, loan lenders are unwilling to give a loan. The financial statement reveals a company's solvency or ability to repay its debts. The acceptance of others. Banks and financial institutions want to know a company's specific financial situation before approving a loan. On the other hand, for a number of reasons, the government or other authorities may inquire about a company's financial status. In these situations, accounts kept in a disciplined way become easily acceptable to interested groups or authorities. Defining ideals and assuring accountability. The purpose of properly maintained accounts is to develop higher values in individuals and organizations, hence increasing understanding about money laundering, fund theft, and cost management through transparency and accountability. Compliance with legal requirements and prohibitions. All sorts of enterprises must keep reliable records in order to comply with specific legal responsibilities and restrictions. As an illustration, laws requiring firms to retain correct records include partnership law, income tax laws, and company law, among others. The main purposes of accounting are to keep a detailed and systematic record of all transactions and to assess a company's financial situation. Everyone is interested in the consequences of financial transactions, which are decided via the accounting process, whether they are individuals or corporations. Accounting allows a business owner to see his company's financial and operational status at any time. Accounting cycle. The accounting cycle is depicted in the diagram below. Almost every bookkeeping and accounting system starts with these stages. The stages are completed in the order listed, albeit the techniques used to do them differ per firm. For example, at a supermarket shop, the details of a sale may be entered by scanning barcodes, or a complex purchase from a customer for an expensive piece of equipment may necessitate an in-depth legal interpretation. A more complete description of each stage is given below. Prepare source documents for all transactions, operations, and other events of the business. Source documents are the starting point in the bookkeeping process. When buying products, a business gets an invoice from the supplier. When borrowing money from the bank, a business signs a note payable, a copy of which the business keeps. When preparing payroll checks, a business depends on salary rosters and time cards. All of these key business forms serve as sources of information entered into the bookkeeping system, in other words, information the bookkeeper uses in recording the financial effects of the activities of the business. Determine the financial effects of the transactions, operations, and other events of the business. The financial repercussions of a company's operations must be recorded. The company is better off, worse off, or harmed in some manner as a result of its transactions. Paying workers, making sales to consumers, borrowing money from the bank, and purchasing things to sell to customers are all examples of common business transactions. The first step in the bookkeeping process is to determine what information is needed for each transaction. The standards and techniques for measuring the financial consequences of transactions are established by the company's chief accountant. Of course, the bookkeeper must follow these norms and procedures. Make original entries of financial effects in journals, with proper citations to source documents. The bookkeeper enters the initial, or original, entry for each transaction into a journal using the source documents. This information is then placed in accounts. Like an extremely thorough personal diary, a journal is a chronological record of events in the order in which they occur. Post the financial effects of transactions to accounts, with references and tie-ins to original journal entries. In documenting transactions, only the official, established chart, or list of accounts, should be utilized. For each asset, liability, and so on, an account is a distinct record, or page. 2 or more accounts are affected by a single transaction. The journal entry documents the entire transaction in one location, and then each item is entered in the impacted accounts. A trial balance is created when all transactions have been posted. As of a specific date, this document contains all of the accounts and their balances. It is impossible to overstate the significance of entering transaction data accurately and on time. One of the main reasons that most businesses use cash registers that scan barcoded information on items is that it collects the essential information more correctly and speeds up data entering. Perform end-of-period procedures. The measures that must be taken to bring accounting records up to date and prepare management accounting reports, tax returns, and financial statements. A period is a set of time that is established by the demands of the business and can range from 1 day, even 1 hour, to 1 month, 1 quarter, 3 months, or 1 year. At the conclusion of each quarter, most organizations require accounting reports and financial statements, and many require monthly financial statements. This is an example of a period's end-of-period requirement. The accountant should be highly involved in end-of-period operations and ensure that the business's accounts are free of mistakes. Some data entry clerks and bookkeepers may not have completely comprehended the peculiar nature of some company transactions, resulting in transactions being recorded erroneously. Accounts should, in theory, be error-free at the end of the period, but the accountant should never assume anything and should do a last check for any problems. Compile the adjusted trial balance for the accountant. It's how management reports, tax filings, and financial statements are made. After all of the end-of-period procedures have been completed, the bookkeeper creates an adjusted trial balance, which is a detailed accounting of all accounts. For their numerous assets, liabilities, owner's equity, income, and costs, small enterprises keep hundreds of accounts. Thousands of accounts are kept by larger companies. The accountant uses the adjusted trial balance to group related accounts into a single total that is disclosed in a financial statement or tax return. A company, for example, may have hundreds of different inventory accounts, each of which is reflected in the adjusted trial balance. The accountant combines all of these accounts into a single summary inventory account that appears on the company's balance sheet. The accountant should follow established financial reporting standards and income tax obligations when combining the accounts. Close the books. Bring the bookkeeping for the previous fiscal year to a close and prepare to start the bookkeeping process for the next fiscal year. The phrase books refers to a company's whole collection of accounts, including journal entries. The transactions of a firm are a continuous stream of activity that do not terminate neatly on the last day of the year, making financial statements and tax returns difficult to prepare. By closing the books for 1 year and beginning with fresh books for the next, the firm must make a clear line of demarcation between operations for the previous year and those for the coming year. The accounting handbook for most medium-sized and bigger organizations lays out in great detail the precise accounts and processes for documenting transactions. A company's chart of accounts, accounting regulations, and policies should be reviewed and updated on a regular basis. Companies do not take this duty lightly. Accounting system disruptions can be big shocks that must be properly considered. The subsequent chapters in Book 1 guide you through the development of an accounting system. Fundamental accounting equation. The fundamental accounting equation, also known as the accounting equation or the balance sheet equation, helps explain the concept that all transactions must balance. Assets equals liabilities plus owner's equity. Net assets equals assets minus liabilities. If you do some algebra and subtract liabilities from both sides of the previous equation, you get this formula: assets, liabilities equals owner's equity. Or, net assets equals owner's equity. Before going any further, acquaint yourself with the cast of characters in the equation. Assets are resources a company owns. Some examples are cash, equipment and cars. You use assets to make money in your business. In other words, the resources are used up over time to generate sales and profits. Liabilities are debts the company owes to others, people other than owners of the business. The biggies are accounts payable and notes payable. Owner's equity, or simply equity, is what's left over in the business at the end of the day. If you sold all your assets for cash, then paid off all your liabilities, any cash remaining would be equity. Many accounting textbooks define equity as the owner's claim to the company's net assets. You may read the explanation of owner's equity and think, that's just another way to say, net worth. In accounting, however, the terms net worth and owner's equity are not interchangeable. The restatement of all assets to their fair market value, which would be necessary to compute a company's net worth, is not permitted under generally accepted accounting standards, GAAP. Summary. In this module, you have learnt the practice of entering your company's financial activities into structured accounts on a regular basis is known as bookkeeping. Accounting includes the recording of financial transactions, as well as their storage, sorting, retrieval, summarization, and presentation in different reports and analysis. Accounting is a topic of study and a career that focuses on completing certain responsibilities. Accountants issue orders, while bookkeepers carry them out. Bookkeepers devote more time to the record-keeping process and the challenges that develop as a result of recording so much data. Objectives of accounting. Assets equals liabilities plus owner's equity.